Welcome to China Unveiled. Many people interested in China-related issues often ask, why has the Chinese yuan been rising this year? Will it continue to climb past 7? When is the best time to exchange currency? In this video, we'll address all your questions about the yuan's exchange rate comprehensively. We won't just cover the surface-level reasons for the yuan's fluctuations. We'll also explore how the People's Bank of China manages the yuan's exchange rate. First, let's clarify the system governing the yuan's exchange rate. According to the People's Bank of China, since July 21, 2005, China has refined its exchange rate mechanism, adopting a managed floating exchange rate system based on market supply and demand, adjusted with reference to a basket of currencies. To put it simply, since July 21, 2005, the People's Bank of China overhauled the yuan's exchange rate system. From that day forward, the yuan's value has been shaped by three key factors. The first is market dynamics. For instance, export companies converting their US dollar earnings into yuan or individuals and banks trading foreign currencies. These activities influence the yuan's rise or fall. The second factor is a basket of currencies. The yuan is no longer rigidly tied to the US dollar. While it still primarily tracks the dollar, the central bank now also considers fluctuations in currencies like the euro and Japanese yen to guide the exchange rate's direction. The third factor is the central bank's direct oversight. Each day, the central bank sets a reference rate, called the central parity rate, and mandates that the yuan's exchange rate can only fluctuate within a specific range above or below this rate. In extreme cases, the central bank may employ a tool known as the counter-cyclical factor to actively steer the exchange rate's trajectory. In essence, the yuan's exchange rate is shaped by both market forces and the central bank's intervention. The goal is to maintain as much stability as possible, as stability is the hallmark China's government has crafted for the yuan on the global stage. Why does the People's Bank of China prioritize yuan stability? The primary reason is to attract foreign investment. The central bank is signaling to international investors, invest in China with confidence. The yuan's exchange rate is stable, and you need not fear exchange rate risks. Considering China's history of economic reforms, it's clear how vital exchange rate stability is for drawing foreign capital. Even today, the yuan's exchange rate avoids sharp swings and remains relatively steady. Over the past year, it has fluctuated mostly between 7 and 7.3, a testament to the central bank's skillful management. Now let's dive into the core question. How does the People's Bank of China regulate the yuan's exchange rate? We've established that the yuan is designed to be stable, but markets are inherently volatile, and the US dollar's movements impact the yuan. So how does the central bank maintain this image of stability? The answer lies in its arsenal of tools. Some are transparent, like the first tool, the central parity rate. The central bank stipulates that the market exchange rate can only fluctuate within 2% above or below this rate each day. So, how is this rate set? It's straightforward. Every morning before the foreign exchange market opens, market makers, major banks responsible for quoting exchange rates, consider two factors. First, what was yesterday's closing price? Second, how did the yuan's relationship with the basket of currencies shift yesterday? They combine these factors to estimate the yuan's exchange rate against the dollar for the day and submit their quotes to the China Foreign Exchange Trade System. Since each bank weighs currencies differently, some prioritize the dollar, others the euro or yen, their quotes vary slightly. The trade system collects these quotes, discards the highest and lowest, and calculates an average. This average becomes the day's central parity rate, announced publicly at 9:15 a.m. For example, suppose yesterday's central parity rate for the yuan against the dollar was 7, with a closing price of 6.995. If the basket of currencies suggests the yuan should appreciate by 100 basis points, today's central parity rate would be 6.995 minus 100 basis points, equaling 6.985. That's 150 basis points higher than yesterday's rate, with 50 basis points driven by market supply and demand and 100 basis points from the basket of currencies. However, sometimes the announced central parity rate deviates noticeably from expectations. That's when the central bank employs another tool, the counter-cyclical factor. This allows the central bank to set the central parity rate at a level it prefers, effectively overriding market trends. Take our earlier example. Market makers' quotes suggest today's central parity rate should be 6.985, up 150 basis points from yesterday. But with the counter-cyclical factor, the central bank might keep the rate at yesterday's level. This indicates the central bank believes the yuan is appreciating too rapidly and has intervened to slow it down. Simultaneously, it may direct state-owned banks to buy dollars and sell yuan in the market to curb appreciation, nudging the spot exchange rate back toward the middle of the fluctuation range. Beyond the central parity rate and counter-cyclical factor, the central bank's third tool is instructing state-owned banks to trade dollars in the market to influence the yuan's exchange rate. In extreme cases, it can impose capital controls, restricting free currency exchange. However, this measure is rarely used as it undermines the yuan's international credibility. With these three tools in mind, we can better understand the yuan's current dynamics. Let's examine how much the yuan has appreciated against the dollar this year. Currently, the yuan's exchange rate is 7.11, up 2.61% year-to-date. Meanwhile, the US dollar index has fallen from 107 at the year's start to about 97 now, a decline of over 9%. Compare this to other major currencies' performance against the dollar. The euro has risen 13.47% this year, the British pound is up 7.65%, the Mexican peso has gained 13.24%, the new Taiwan dollar is up 9.14%, the Japanese yen has increased 6.65%, and the South Korean won is up 5.64%. Among Asian exporting nations, only Vietnam and India's currencies have depreciated against the dollar, likely to support their export-driven economies, as they've absorbed much of China's supply chain. Notice a pattern? The yuan has depreciated against nearly all developed countries' currencies except the US dollar, suggesting it's only appreciating against the dollar. This data implies the People's Bank of China is deliberately tempering the yuan's strength, resulting in its modest appreciation against the dollar this year. Indeed, since August 2022, the central bank has consistently used the counter-cyclical factor to manage the exchange rate. Over the past 2 years, the dollar's strength weakened the yuan, prompting the central bank to intervene to support it. If we calculate the theoretical yuan-dollar exchange rate based on the US-China interest rate differential, the yuan remains overvalued, more so than during the 2015 stock market crash. Why? China's economic slowdown and the dollar's strength forced the central bank to spend dollars to prop up the yuan year after year. Now, with the dollar weakening this year, the central bank must control the yuan's appreciation to preserve its stable image. Thus, the counter-cyclical factor remains indispensable. What's the ideal exchange rate range for the yuan? I believe the central bank aims to let the yuan appreciate only against the dollar while depreciating against other developed nations' currencies. This strategy leverages price advantages to boost exports to markets outside the US, offsetting losses in the American market. My calculations suggest the yuan's appreciation ceiling is around 7. If the rate exceeds 7, the yuan's appreciation would surpass the South Korean won's. At 6.8, China's export price advantage over countries like Japan and Taiwan would vanish. Thus, I believe 7 is likely the upper limit for this round of yuan appreciation. It's clear that the People's Bank of China has paid a significant price to maintain the yuan's stable image. Over the past few years, as China's economy slowed and the dollar strengthened, the yuan should have naturally depreciated. Yet, the central bank held it above 7.3, leading to an overvaluation exceeding that of 2015. During the 2015 stock market crash, the central bank depleted $1 trillion in foreign exchange reserves to support the yuan. Back then, capital flows were relatively free, but now the central bank cannot afford such losses. Instead, it has tightened foreign exchange controls, sacrificing the yuan's international credibility to maintain stability. Now that the dollar has weakened and global currencies are appreciating, the yuan cannot rise too quickly. It must uphold its stable image. Rapid appreciation would also harm China's exports, particularly amid the ongoing US-China trade war, which already strains export markets. China urgently needs to expand sales to other countries. Thus, the central bank carefully manages the yuan's exchange rate to appreciate only against the dollar, while depreciating against other currencies, aiming to boost Chinese goods sales globally. To summarize, the yuan's exchange rate is unique. It's neither fully market-driven nor a fixed exchange rate. The central bank meticulously manages it to keep fluctuations within a narrow range. When Trump labels China a currency manipulator, he's not entirely wrong. Other nations intervene discreetly, but China's central bank does so openly. It's part of their official strategy. No other country systematically employs the counter-cyclical factor, state-owned bank trading and capital controls on such a scale to manage its currency. Consequently, Xi Jinping's vision of Yuan internationalization seems unrealistic. The Yuan's exchange rate has deviated from market forces for too long. How could such a currency become a global reserve? If China suddenly abandons its exchange rate controls, discarding the Yuan's stable image, countries holding Yuan reserves would face significant losses. Thus, the dream of Yuan internationalization remains largely a self-indulgent fantasy, unlikely to be taken seriously by others. Thanks for watching and joining us on this journey to unveil China's many layers. If you found this video insightful, please give it a thumbs up, share it with others, and hit that subscribe button to stay updated. See you in the next video.